Are you a new or seasoned investor looking to switch things up in your investment account? Well, how about a hands-off lazy portfolio strategy designed to better your long-term financial goals? Hey guys, this is Nick with Nick Does DGI, and welcome back to my channel. In today's video, I want to go over a simple yet popular investment strategy called the 3-fund portfolio using low-cost Vanguard ETFs. So let's get into it. Before I go over what exactly entails this strategy, I need to give some context. This simple investment strategy was popularized by quote-unquote bogleheads, or avid investing enthusiasts of late Vanguard founder and investor advocate John Bogle. He was considered to be the father of index investing. Bogle once said that simplicity is the master key to financial success, and the 3-fund portfolio is a simple portfolio comprised of 3 broad asset classes. 1. A U.S. total stock market index fund. 2. A total international stock market index fund. And 3. A total bond market index fund. For purposes of this video, I'll be using Vanguard index fund equivalent ETFs, the reason being that the original boglehead investors largely invested on the Vanguard brokerage platform in tax-advantaged accounts like a 401k or IRA, where these index mutual funds were only available for purchase. But with the rise of zero-fee commission trading brokerage platforms, anyone can buy Vanguard equivalent ETFs with just about any brokerage. So why use index funds? Bogle, among other great financial gurus, emphasized the importance of diversification to reduce volatility and maximize risk-adjusted returns. Endless amounts of research has shown that simple broad market index funds or ETFs outperform actively managed funds in the long term. Plus, Vanguard continues to offer the lowest expense fees of any fund provider out there. After 10 years, 85% of large cap actively managed funds underperformed the S&P 500. After 15 years, 92% of those funds underperformed. From 2011 to 2019, the S&P 500 outperformed active fund managers until finally scoring a win in 2020, 19.4% to the S&P 500's 16.3% return. Now let's get into the different asset classes of ETFs. I know that it's imperative that you should at least know a bit more about what each ETF holds and how it performs. A total stock market index fund represents the whole market. Vanguard's ETF equivalent is ticker symbol VTI. VTI contains over 3,600 stocks traded in the US market with a very low 0.03% expense ratio. You could invest in VOO, the S&P 500 ETF that tracks the largest 500 companies, but in order to gain full exposure to the small and mid-cap stocks, you might be better off being invested in VTI, and you won't sacrifice much performance if any. I backtracked VTI against the S&P 500 and found that its performance was nearly identical despite containing small and mid-cap companies. Likewise, to gain exposure to the international equity markets, we look at ticker symbol VXUS, Vanguard Total International Stock ETF. This ETF seeks to track the performance of the FTSE Global All Cap, which measures all companies located in developed and emerging markets outside of the US. With over 7,400 stocks and available for a low 0.08% expense ratio, this is the most accessible ETF for investor. The price to pay for access to global exposure, however, is underperformance. Backtracking VXUS against VTI and VOO, you can see that it largely underperformed the US market since 2011. These illustrations depict the relative asset class performances since 2006, while looking at emerging markets in purple or international stocks in dark gray. You'll still see that both asset classes still attain respectable returns time to time, and research shows that there are years when international markets outperform the US and vice versa. Nonetheless, it's still not a bad idea to diversify your exposure geographically. As of January 2021, the US makes about 56% of the global equity market value. And despite international indices underperforming, many of the best performing stocks are consistently outside of the US, about 74% on average each year since 2010. The third component of the 3-fund portfolio are bonds. I think I can go down a rabbit hole and take up an entire video to talk about bonds, but for the sake of this video, you can think of bonds as fixed income instruments that represents a loan by an investor to a borrower, typically a corporate company or government. Bonds seek to offer the following: a predictable income stream as bond interest payments are made periodically throughout the year. Bondholders receive their principal if held to maturity date, so this might be an alternative way to preserve capital. And 3, bonds can minimize exposure to volatile market swings. Ticker symbol BND, or Vanguard Total Bond Market ETF, seeks to provide exposure to taxable investment-grade US dollar-denominated bond market. With over 10,000 bonds offered at a low 0.035% expense ratio, BND is one of the easiest ways to get access to the US bond market. And as far as BND's performance goes, there's not much to write home about. Backtracked against VTI and VXUS, BND clearly underperforms. However, BND offers a stable preservation of capital and predictable fixed income of monthly distributions, which makes sense for those closer to retirement age. By this point, you might be wondering how to allocate your own 3-fund portfolio. The short answer is that there is no one-size-fits-all approach to allocation. Financial experts recommend that the younger you are, the more you invest into equities and make incremental increases to bond exposure as you approach retirement age. Others use the rule of 111 or 110 to help manage your risk and reward. This rule states that the percentage of your money invested in stocks should be equal to 110 minus your age. So for example, if George here is 30 years old, the rule of 110 states that George should have 80% of his money invested in stocks and the remaining 20% in bonds. The logic is that the younger you are, the more time you have to weather downturns and let your stock investments compound. The name of the game is wealth retention as you approach retirement age and start playing it safe. If I were to convert my investment portfolio into a 3-fund portfolio, considering my age and investing time horizon, I would most likely go with the popular 80-20 allocation, 80% stocks and 20% bond ratio. Of the 80% stocks, 64% US total market VTI and 16% international total market VXUS. On the other hand, if you are approaching retirement age like my parents, this might be more like 50% stocks and 50% bonds. And of this 50% stocks, 40% US total market VTI and 10% international market VXUS. But the beauty of this is that you can adjust these percentages to whatever you want. Today, I'm going to go over a quick tutorial on how to create your own 3-fund portfolio on M1 Finance within seconds. So here we are on the homepage of M1 Finance. You have your pie slices to the left and on the bottom by line item, and historical portfolio balance in the middle here. To create a new pie, let's click on Research. And under My Pies, we want to create a new pie right here that is unused. And this will lead you to the search page here, but because we already know what slices we want to add, we can go straight to the top right search bar and start adding the 3. And do the same for VXUS and BND. Once we have all 3 in our card at the bottom, click on Add, and your new pie is created. The holdings are evenly split by default, but click Edit to rename the pie 80-23 Fund Portfolio and adjust the percentage weightings to your liking. Here, we are going to do a 64-14-20 split. Once you are all done, click Save. And then Add to Portfolio for this to show up on your main pie. Easy as pie, get it? If you are interested in getting started with M1 Finance, I will include a referral link in the description below. They are running an awesome promotion until the end of this year, where if you fund your account, you and I will both earn $30. Please note that this video is not intended as financial advice, nor am I a financial advisor. Past performance is no guarantee of future results, and please take this information with a grain of salt. Please do your own due diligence and research when deciding to invest in investable securities. If you found this video helpful, please consider clicking the like button and subscribing to my channel. Hit the bell notification to receive an alert on the latest videos. The YouTube algorithm likes these sorts of engagements and helps my channel get shown on more homepages. Until next time, take care.